Hello, everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much, much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. My name is Sava, and today we're going to investigate event studies, one of the most famous and important techniques in quantitative finance that allows you to quantify and measure the impact various news releases, corporate announcements, or any other events have or might have on corporate value by studying the stock price dynamics around the event date. Event studies has gained lots of momentum and popularity as an econometric technique since the 1980s and the 1990s when it has been developed, and can be considered one of the go-to techniques to test for market efficiency. So, long story short, event studies are just wonderful, and we are going to learn more about them based on a very easy and prominent example. Perhaps the most well-known publicly traded game design corporation is Activision Blizzard, and arguably the most important event in any year for Blizzard is BlizzCon, when they announce new gaming titles, and it usually has a large impact, a material impact on their stock price. So in 2018, the BlizzCon has been even more prominent than usual because Blizzard has announced a lot of different gaming titles, including the infamous now Warcraft 3 Reforged, that has been quite a failure. So we're gonna measure, did the stock market anticipate the failure of Warcraft 3 Reforged at the announcement of the game at BlizzCon? The date of BlizzCon was 2nd of November 2018, and the announcement has been made in the evening, so the stock market theoretically would have adjusted to any news released at the conference in the next trading day. So as 2nd of November has been a Friday, the market is expected to incorporate the relevant information regarding future cash flows to Blizzard based on gaming announcements on the following Monday, so 5th of November 2018. So here we've got stock prices from end of July 2018 all the way to end of December 2018. So just to make it clearer for ourselves, let's highlight the event day. Here it is, 5th of November 2018, and highlight it, for example, in orange so we don't miss it. Then the event study methodology also allows you to test whether the stock market has anticipated the effect the event would have on the corporate value. So it allows to test for market efficiency and all the more so insider trading. Perhaps some insiders were trading Blizzard shares before the announcement even. So for anticipation testing, we need to select the anticipation window. So a range of trading days before the event when we would check whether there were any significant stock price movements there. And again, selecting the length of an anticipation window is more of an art than a science, but the convention is that 5 to 10 trading days is generally enough for studying such corporate announcements. So we'll take an anticipation window of 10 days, and so that we don't miss it again and clearly see what it constitutes our anticipation window precisely, let's select the 10 rows that preceded the event day of 5th of November 2018 and highlight them in green, for example. Then, and it is even more important for market efficiency concerns, the adjustment window. The adjustment window, just as the anticipation window, is a sequence of trading days directly right after the event day that allows us to test whether there has been any significant price changes after the market should have already reacted to new information being released. It means that if there are significant price changes after the announcement, then the market is inefficient in incorporating new information and has either underreacted to the news release if the direction of adjustment is the same as the direction of the event effect, or overreacted if the directions of those effects are reverse. So let's select an adjustment window of 10 days as well, and just as with the anticipation window, select 10 trading days right after our event of 5th of November and paint them yellow. And now we can clearly see even visually what time period are we most concerned with in our event studies. Then, to compare the behavior of the stock price and the stock returns in our event day anticipation window and adjustment window, we need to select the estimation period, the estimation window, which basically would be our business as usual, that we would compare our returns during those three windows with. And the longer the better. Generally, you are looking at least 30 days of an estimation window, but here we have even more of that. We've got the data from end of July, so we will have our first return observation on the 1st of August. So let's select all our data points that are available for us straight from the 1st of August all the way to 19th of October, because after the October the 19th, our anticipation period begins. And we can see here clearly that we've got 57 days in our estimation window, which is again way higher than the minimal recommended 30 days. And let's paint it blue. Now we need to just select that our estimation window is 57 days, just for the sake of it, so that we don't forget about it later on, and start calculating the returns in our estimation periods, in our anticipation, adjustment windows, and most importantly on the event day itself. And we've got the stock price for Activision Blizzard and stock prices or index values for S&P 500. The S&P 500 data is here to allow for meaningful comparisons of the stock dynamics of Activision Blizzard with the market, so that we can be sure that any abnormal returns we detect are due to the inherent impact of an event on the company we're studying and not on the overall market dynamics. So here, let's just calculate the returns using the simple formula, price today divided by the price yesterday minus 1, and calculate those both for the stock price of Activision Blizzard and for the S&P 500 index. And now, let's talk about various models that exist in event studies. There are three major models: constant return, market adjusted, and CAPM. And they are different in terms of the method they use to calculate abnormal returns. To detect whether some event had a material impact on corporate value, we need to calculate abnormal returns, so returns that are different from what one would expect in our windows of interest: anticipation, adjustment, and the event itself. So the constant return model is perhaps the easiest of them all, because in the constant return model, we just assume that the expected return for our stock is just equal to average daily return during the estimation window. And then we would be able to calculate the differences from the realized returns and the expected returns, and those would be our abnormal returns that we would then use to generate inferences regarding whether an event was impactful. So here, our average return during the estimation window would just be the average of all returns in the blue period. So all the way down to 19th of October 2018, and we can calculate the average return, and it would be minus 0.06%. So now the abnormal return for the constant return model would be just the return of Activision Blizzard on a particular day minus the expected return, so the average return during the estimation window, and we need to log that because we don't want the expected return to change observation to observation. We can enforce this formula and bottom-right click it all the way down and get our abnormal returns day by day. For the market-adjusted model, it still remains quite easy and simple. For the market-adjusted model, we just assume that the normal return for a stock, the expected return for a stock on a particular day, is roughly equal to the return of the market at that day. So we basically assume that the alpha of the stock is 0 and the beta of the stock is roughly 1. Sometimes it can be a questionable assumption, particularly in case of riskier tech stocks, such as stocks of game design corporations, but nevertheless, this model generally provides some decent insight. So here, our abnormal return for the market-adjusted model would be just the difference between the return of our stock and the return of S&P 500, as it is perhaps the relevant benchmark for a US-based company. You could argue that NASDAQ would be a better proxy, but they show roughly the same dynamic long term. So S&P 500 would certainly do here. So we can calculate the difference and calculate the market-adjusted returns all the way down throughout the whole observation period. Now, the final model of abnormal return calculation is CAPM. And for CAPM, the expected return is just the return that one would expect by fitting the market return in a particular day into a CAPM model with alpha and beta estimated using a linear regression for the estimation window. So here we just can calculate alpha and beta throughout our estimation window, plug them into the abnormal return calculations, and get a more refined approximation of what the expected return should have been and how the realized return is different to expected return. And that would be a decent estimation of how impactful an event was. So for alpha and beta, we can just use intercept and slope and estimate the intercept based on Blizzard returns throughout the estimation window and S&P 500 returns over the estimation window. And we get minus 0.01, so roughly 0. And for the beta, we can use the same formula, but instead of intercept, we can just type in slope. And we can see here that beta of Activision Blizzard is actually quite high. It's closer to 2 than to 1. So perhaps here is the case where simple market-adjusted model that assumes beta to be equal to 1 fails. But nevertheless, there are some disadvantages in using CAPM for event studies that market-adjusted model avoids. For example, if you have small samples, small estimation windows, the measurement error, the estimation error of alpha and beta can be quite large. So you sometimes can be just better off by simply subtracting the market return. So generally, if you have stocks that you suspect have beta significantly different from 1, and you have a decent sample size in terms of the estimation window, use CAPM. If your sample size is smaller, or your stocks generally have betas that are very close to 1, use the market-adjusted model instead. And if you have no relevant benchmark or data is unavailable, then you have to stick with the constant return model. And let's see what the abnormal returns for CAPM are, and finally get to calculate the effects of our events, anticipation of the event, and the adjustment to the event. For the CAPM, the abnormal return is just the difference of the realized return and the expected return as per CAPM, given our calculated values of alpha and beta. So the expected return would be our alpha, and we need to lock both the column and row here, as we don't want it to change. Alpha stays the same, plus beta, and the same story here, locking everything, times the market return at a particular day. We close the bracket, enforce the formula, and bottom right click it all the way down. So now we've got our abnormal returns calculated for all three models. What we're concerned with now are standard deviations of abnormal returns that we would then use for hypothesis testing to determine how significant the deviation of abnormal returns from 0 are in our periods of interest. So here we can just enforce the stdev.s sample standard deviation formula for all three columns with abnormal returns, and we can see that the standard deviations for returns that are adjusted for market are quite a bit lower than the one from the constant return model, because the market movement captures systematic risk the stocks are exposed to, and what we are left with is arguably just idiosyncratic risk. So market adjusted model and CAPM can be more effective in terms of estimating variance and can lead to a greater statistical power of your event studies test. And next, as the length of both of our windows, anticipation and adjustment, is equal to 10 days, we need to also calculate the standard deviation of 10-day abnormal returns. We can do it using the simple adjustment, multiplying the daily standard deviation of abnormal returns by the square root of 10, where 10 is the length of the relevant period, enforce this formula and drag it for all three of our models. And then, as we are also concerned with the behavior of the stock price throughout all three windows, anticipation, adjustment, and the event itself, we also need to calculate the standard deviation of abnormal returns throughout the period. So throughout anticipation plus event plus adjustment. And it would be 10 plus 10 plus 1, 21 days. So we also need to calculate the 21-day standard deviation by multiplying the daily standard deviation by the square root of 21. And what is also handy, and totally coincidence here, is that a 21-day period is roughly a trading month, so we are calculating the abnormal return and its significance during a trading month that surrounds BlizzCon. Now we need to calculate our abnormal returns in the respective periods. For the event day itself, we can just plug in or refer to the return on the orange row. So here it is, minus 6.68%, quite high and negative, and drag it around. Then for calculating the abnormal returns for windows that are longer than one trading period, there are two methods one can employ. First is simple cumulative abnormal return, or CAR. For CAR, you just sum the returns throughout the window. And first of all, it's simpler mathematically, but it can lead to biases because of continuous compound rate of appreciation. And to avoid the continuous compound rate of appreciation bias, one can just calculate the buy and hold abnormal return, or BHR. BHR uses products instead of sums and is harder to implement mathematically, but not by much, and gives you a precise picture of what would be the holding period return over a particular window. So first, let's calculate cumulative abnormal returns, or CARs. So for the anticipation window, they would just be the sum of returns over the green window over here. For adjustment, they would be sums of abnormal returns over the yellow window over here. And in total, we can just calculate it as the sum of the three. For buy and hold abnormal returns, we need to use the product function, but for a single day window, as we have for our event itself, the buy and hold abnormal return is equivalent to cumulative abnormal return for obvious reasons. So here we can just refer to our cumulative abnormal returns for the event days, but for windows that are longer than 1 day, we need to apply the product 1+ function that is instrumental in calculating holding period returns. So for anticipation, we calculate product 1+ all returns in the green -1 and enforce this formula using Shift Control Enter, and then dragging it across all three models. For adjustment, we do exactly the same, product 1+, and calculating our buy and hold abnormal return over the yellows. And for the 21-day window that encapsulates all three, we can do product 1 plus all the greens, the orange, and the yellow, minus 1. And as you can see, apart from the trivial case of a 1-day window, as we have with the event itself, the buy and hold abnormal returns are always lower than the corresponding cumulative abnormal returns, because a sum or an arithmetic mean is always higher than the geometric mean. And in this case, the buy and hold abnormal return is arguably a more precise measure, as it accounts for the continuous compound appreciation rate. Now we can calculate t-stats and p-values for various event windows and for various models. A t-stat would be just the abnormal return divided by the corresponding standard deviation, and this would tell us how significantly different our abnormal return is from 0. How likely it is that this deviation occurred due to random chance, and how likely it is that the event or anticipation of the event or the adjustment of the market after the event were actually genuine and significant statistically. So for the t-stats for events, we can divide the respective cumulative abnormal returns and buy and hold abnormal returns by standard deviations, daily standard deviations here because of the corresponding window length, and we get t-stats that are consistently greater than 2, which is a good sign. It means that the effect indeed was significant, using this rule of thumb that a t-stat that is greater than 2 in terms of absolute value is significant. Then for the anticipation window, we need to divide our anticipation cumulative abnormal return by the 10-day standard deviation, and here we can save a little bit of time by just locking this standard deviation and dragging it for both anticipation and adjustment. And here for the total period, we can divide our total cumulative abnormal return by the 21-day standard deviation and lock the row over here. So for the t-stat in terms of the buy and hold abnormal return, we need to again divide the buy and hold abnormal return for this particular window by daily standard deviation and drag it around 3 models. And for the other 3 windows, we can again save a little bit of time by copying those t-stats across, as we have locked all of the relevant rows. And finally, we can also estimate the p-values to formally test for the significance of our results. And here we can do it in one go, basically, by just applying the two-tailed t-distribution function, plugging in the absolute value of respective t-stat, and here we need to input the number of the degrees of freedom. And remembering back how long our estimation window was, we actually can use it to calculate the number of the degrees of freedom. As we have estimated our parameters, that is average return, expected return for the constant return model, our market returns for CAPM in terms of alpha and beta, we can treat it as the number of the degrees of freedom initially, and then we can subtract the number of parameters in the model. For constant return model, there is only one parameter, so 57 minus 1, the parameter is the average return, so we can close the bracket and enforce the t-test. For the market adjusted model, it's also one parameter because our only parameter is the market return. But for the CAPM model, we have actually got 2 parameters, alpha and beta, so here instead of -1, we should have -2 for alpha and beta respectively. And we can enforce this formula and drag the p-value formula all the way down to simultaneously calculate all of our p-values. And now let's make sense of our results. First of all, we can see that the p-values for the event day in all 3 models and for both CAR and BHR. Again, no surprises here because CAR and BHR are equivalent for one-day periods, are statistically significant, all lower than 5%, and some of them, basically for market adjusted and CAPM, lower than 1%. It means that indeed the impact that BlizzCon had on Activision Blizzard corporate value was material. It was statistically significant. It did significantly reduce the corporate value of Activision Blizzard because the stock market has accurately predicted that the games Blizzard announced at BlizzCon were worse than initially expected, and they harmed the expected cash flows that investors would receive from customers purchasing those games. Also, we can see how detrimental the effect was. It has been actually quite high in terms of magnitude, minus 6.7, minus 7.3, minus 7.8%, depending on the model. So here, all three models give very similar results. Releasing a pretty bad game for Blizzard can be worth around 7% of its market capitalization, which is quite a lot. Then, in terms of anticipation, we can see that our p-values are all remarkably high, meaning that there was no significant anticipation effect. The market was not expecting BlizzCon and games announced at BlizzCon to fail so much, which is perhaps unexpected. And we can also infer that there has been no insider trading coming up to the event. In terms of adjustment, though, we can see that all of our p-values are again less than 5%, basically telling us that there has been a significant adjustment effect even after the event date of 5th of November itself, meaning that the market has not been fully efficient in incorporating the information timely into the stock price. And looking at the magnitude and sign of the adjustment effect, we can see that it's of the same sign as the event effect itself, meaning that the market has underreacted to the negativity of the event's impact. So the investors have underestimated how detrimental the effect of releasing a bad game or announcing a bad game was. And for the total impact, finally, we can see that the total impact on the Activision Blizzard stock price during the 21-day window, so full calendar month, is also overwhelmingly significant, all p-values being less than 5% in all models, and both for CAR and BHR, and the total impact is significantly negative as well, sometimes reaching even 30%. Therefore, one can conclude that all three models are giving significant results, and we can safely assume that the announcement of such a poorly rated game has been incorporated in the stock prices of Activision Blizzard since the very beginning. Event studies are a very powerful tool. You can apply it to various news events, various corporate announcements, disclosure releases, and so on and so forth. You can study how various events impact different companies. Do some companies profit from some events? Do some companies lose based on different events? And it also is a remarkably easy test for market efficiency. In the next video, I'll show you an even easier and more concise way to implement event studies using a multiple regression framework. But as for now, that's all there is for the event study methodology. Hope the video was helpful. Please leave a like under this video if it's indeed so. Don't forget to subscribe to our channel and click the bell notification button below, and I'm eager to see further suggestions for videos in the comments. Thank you very much, and stay tuned.